Good afternoon, everyone. Welcome to this webinar. I hope everyone's managed to get on. I might leave it just until a minute past, just to make sure that anyone who's forgot their PIN number or can't get on. And in the meantime, you can enjoy the clash of colours that I've decided to wear today of green with the Waracle orange is clearly not a go-to for the future. Welcome, I'm Sharon Dickey, I'm Waracle's Chief Commercial Officer, and we're totally delighted that so many of you could join us today. Clearly today's topic is at the core of Waracle's reason for being, and it's right at the heart of everything that we do. I personally have worked in and around banking channels for nearly 25 years and have seen some dramatic changes and many layered incremental changes in the banking channels. I've worked with the issues of layering costs without being able to get to replace older technology when newer channels come along, and grappled with the challenges of adoption across different segments and across different markets. So hopefully have some empathy with what many of you are facing today. With regards to our agenda, so Blair, I'm not going to go through all of this, but what Blair is going to discuss today is potentially quite bold. We're going to go through our argument that I think most of you will agree with the high level statement, but we understand that you've got different challenges in terms of achieving it. Mobile isn't new, but some of the technologies, some of the behaviours, and of course, pandemics that we face are absolutely new, and we think this even more substantiates why we think mobile is the imperative. Just a tiny bit on who is Waracle. I certainly won't labour the point. If you hadn't picked it up from the title of the slide, we're all about mobile solutions and expertise, primarily in the market of financial services and in the incredible world of digital health as well, which, believe it or not, probably have more in common than you'd think. Most specifically, or most especially, that both are very highly regulated markets, and security is of utmost importance. We totally believe that mobile isn't just another channel, it is the most important channel to tweak, to innovate with, to grow, to plan for. We've been in this game since 2007 with the launch of Apple's first iPhone, and haven't lost 1 ounce of enthusiasm for it since. We work with some incredibly visionary clients and creating apps and developments that we know make a difference to how people live, how they work, and how they play. Before I hand over to Blair, I'll touch on just some of the admin side of things. There'll definitely be time at the end of this for you to ask questions, but you don't have to wait till then. If you use the chat icon at the bottom middle of the screen, just fire away with any questions, and I'll try and get to them all at the end of Blair's presentation. So I genuinely hope you enjoyed the session. I'm going to hand over to Blair, who has incredible experience across financial services, both working within them and also working outside in. And he's going to go through our argument of why mobile isn't just a channel, it's an imperative. So over to you, Blair.
Thanks so much. And hi everyone. It's a very unusual situation when you're doing these kind of webinars and you can't see faces to see if people are engaged or not. So fingers crossed I'll manage to stop you from opening up additional tabs, but I won't be able to tell whether you do or not. So I'm going to start off my presentation with a rather bold statement that pertains directly to the financial services industry. And that bold statement is mobile's just getting started. And don't adjust your sets. This isn't 2013. You haven't logged into a previous time period. And yes, over the last 10 years, pretty much everyone has proclaimed between 2010 and 2020 that this is the year of mobile. But I think I've got a clear justification for why I think mobile's just getting started in the financial services industry. So what do I mean by just getting started? Well, mobile devices are everywhere. And we in the West especially are habituated to our smartphones. The predictions are that there'll be around about 3.3 billion by 2022, And that's 3.3 billion very personal devices. If you think about the kind of information that you share with your smartphone, you share more information with your smartphone than you potentially would with some of your closest relatives. And just 12 years ago, we were playing Angry Birds and checking in on Foursquare. And now, and as I say we now, but I now, bank, save, invest, account, insure, plan, and adopt financial services on my smartphone. And whether that is Google Pay or QuickBooks or MyAviva, Molo, Waggle, Coinbase, for a certain cross section of customers and for institutions, you know, smartphones are ubiquitous and they are everything. And I hear you all shouting at the screen, well, wait a second, haven't we moved past the tipping point? Even my gran has a smartphone. And this is true. Even my 84-year-old gran does have a smartphone. But I suppose that the key thing to understand is that having a device doesn't really change your behaviours, your motivations, and your underlying biases. And especially when you've been used to, across a lifetime, engaging with institutions and organisations, especially in relation to your finances, in a particular way, your kind of opportunity to shift out of that mode of interaction is actually quite a difficult and friction-full process. And so to try and illustrate this for you guys, I've got 3 quotes for illustration purposes. Over the last 6 weeks, these are 3 quotes that my parents have said directly to me across my dining room table. And I'll just run through them. The first one's from my mum, and it said, I have transferred money a couple of times on my laptop, but I really didn't like the idea of doing it. I would never use a mobile phone to transfer money. So the idea that a sort of basic and reasonably kind of sort of easy to do transaction, because it habitually has been done either by handing over a check or by going into a bricks and mortar store to arrange that transfer, the idea that you would do it via a different medium is just maybe a bridge too far. And I should preface this by saying that my parents are in their mid-60s and have had mobile devices for easily 10 years. The second one's from my dad. It says, why is my bank forcing me to have a banking app? If I don't want to use the internet for my finances, I won't. So this illustrates the point that I made about the idea that if you've had a particular relationship with an institution or an organization, especially in relation to something as personal as your own finances, it's very difficult to shift out of that mode. And actually, you need taken on a journey by the organizations that you're interacting with. And the last one's from my mum. She says, wouldn't allowing personal details to be seen on an app on your phone make it easier for people to steal them? So there's this kind of overarching security concern that's related to devices and to device adoption. And so, I mean, essentially what we're talking about here is adoption barriers. And these adoption barriers exist for individuals, but they also exist for the institutions. And I suppose if you're creating, you know, applications for employees, those individuals work within your institutions as well. And so that range of issues could be related to security, support, lack of information, potentially underperforming apps if you already have apps, a lack of scalability, a lack of integration, a lack of communication. But I suppose it all really boils down to, I suppose, a difficulty in driving organizational change and or embodying personal change. So there's intricate, interlinked problems that I suppose mean that certain organizations in the financial services industry really struggle to have a mobile first strategy. And again, I suppose you'll all be shouting at the screen, well, of course there's laggards, Blair, but surely mobile's at the heart of every business strategy right now in 2020. And I suppose in some instances, there'll be mobile teams and there'll certainly be mobile applications, but having a mobile app isn't the same as being a mobile first organization. Now, as Sharon mentioned, across the kind of 11 years that I've been working in digital and in digital marketing, I've worked for big 4 banks, insurers, accounting firms, pension providers, wealth management, retail banks. And I also actually, when I was 16 through to when I was 21, worked as a teller in the Clydesdale Bank. So I know a little bit about financial services from a range of different perspectives. I should probably have a bigger pension pot than I do because of that, but that's another point. So yeah, in a similar way to me using my parents as a vehicle to make a point, these are comments that I remember from my colleagues or from customers in situations over the last kind of 10, 11 years. And the first one is paperless. We still print millions of pieces of paper each year and send them in the post, which costs us a huge amount of money. If you think about it, if an organization kind of draws the lines of engagement with their consumer base and people expect statements and offers via direct mail and the like, shifting people away from that sort of habituated experience is quite difficult. If you're printing 6 million bits of paper per year and you're sending them out in the post, that's a huge cost base. And that's money that could be shifted into a research and development budget, and that could drive digital innovation, or that could create, better and more future-facing digital communication structures. But a lot of banks and a lot of pension providers and a lot of investment companies will still spend a huge amount of money and time processing and parsing out these physical bits of paper. The second one is, let me tell you, we're not a digital bank, we're a legacy telephony bank. And this was from my time at Tesco Bank. And so, if you stood up a bank 25 years ago in comparison to setting up a bank now, just actually building the infrastructure and the products within that business are just completely different now. And like this comment mentions, if the primary means of acquisition 22 years ago was people sending in applications through the post or people calling contact centers, you've built a business that is essentially a telephony acquisition business. And within a period of kind of 8 to 10 years, actually now all of your acquisition is occurring via the web and via mobile, and people are starting to service their accounts via mobile apps. It's a huge shift for an organization in a very short period of time. And it means that, what you have is not necessarily a mobile first organization, but you have a business with a mobile channel. And the last one is, we can't spend money trying to get people to use the app when they're just going to end up calling the contact center anyway. And I suppose that, to Sharon's point about the pandemic and about 2020 as we've experienced it, is that we kind of have to spend money to try and convince people to use scalable contact options, because the opportunity is there. I know we feel like there's existing established motivations and biases, but we can incrementally nudge people in the direction of using digital channels. And so some quick fire stats to back up my claims. So some mobile banking apps might have as low as 20% or less customer adoption. Only 30% of smartphone users in the UK utilize mobile payments technology. Consumers 60 plus are still wary of purchasing on the mobile, as I illustrated with my parents. 85% of small to medium-sized enterprises don't use accounting apps to manage their accounts, like Xero or QuickBooks. 35% of UK insurers don't have a mobile application, which, when you take into consideration how much of their trade will be bought via price comparison websites, means there's very little brand touch points for them to actually build a relationship with their consumer base. Commodity trading is still done by phone and email. I mean, a range of trading is still done, I suppose, in that very personal one-to-one manner. And there's probably a lot of change to come in that sort of segment of the financial services industry. And the last one, I suppose, is just touching on money services, in that 95% of foreign currency transactions still happen with paper money. I mean, now that we have the facility to, we should be loading up, cards and adding them to our mobile payments rather than necessarily going to take euros out of our local Tesco. So this brings me through to why mobile in 2020. And I think you could probably all guess, because everything changed in 2020. And so I'm just going to rattle through these bullet points here. Even we had customers that couldn't go into branches, contact centres that were overwhelmed. I mean, show me a banking app during the first 6 months of 2020 that didn't have an interstitial overlay that said, you know, don't contact our customer centres because they're overwhelmed at the moment. Insurance claims skyrocketed, our staff couldn't go into offices, people didn't trust ATMs, shops didn't want cash, people needed access to quick lending, businesses needed to pivot into e-commerce space and also needed capital to do that. Mortgage holidays needed offered, people invested rather than spending, markets dropped and stabilized, crypto dipped then boomed, flour ran out, and toilet paper hoarders became PPE drop shippers. Now the last two are in there to add a bit of brevity to the situation because 2020 has been pretty tough. But I think that we'd all be in agreement that what didn't change in 2020 was the need for digital transformation in financial services, because never had there been so much operational strain, never had there been such a need for scalability of solutions, and never had there been a greater need or a more pressing need for process improvement, and never had there been so much change in such a short period of time. And with that change, came a huge amount of risk. But I suppose in any situation where there's so much change, there's also demand, which means there's opportunity. And yeah, any PowerPoint wouldn't be worth its salt without some kind of inspirational quote. And so we have this one in here of Charles Darwin saying, it's not the strongest of species nor the most intelligent that survives. It's the one that's the most adaptable to change. And I suppose that that's the key thing that I wanted to get across, is that change is inevitable. It just means different things to different businesses. And so in the financial services space, we probably have, probably two ends to a pretty diverse spectrum where, at one end, you've got businesses that have been stood up in the last kind of 5 years where mobile is absolutely key and potentially the only channel for interacting with their consumers. Whereas at the other end, you have large established businesses which have been around for hundreds of years and potentially have been untouched in their kind of day-to-day interactions with customers by digital technology. And so at one end of the spectrum, that change might mean creating a mobile application for the first time, or creating a mobile first web experience, or utilizing digital innovation to improve processes and operations in your back office. Whereas at the other end of the spectrum, it might be about driving mobile application adoption by your consumer base, creating new add-ons to your mobile offering, whether it's chatbots or the like, or surprising and delighting people with features and functionality that might create new sort of brand memory structures and build on that potential for capitalizing on demand during this period of time. And I suppose arguably it could mean developing new mobile first business models. But the one thing that is clear to us is now is the time to invest in mobile. So that's where we've kind of got to on my argument. I think that what's useful, or what I wanted to convey, was that just, having a mobile application, for say a subset of the financial services industry like banking, isn't necessarily what I am plumping for or describing here. So what I wanted to do was try and sort of illustrate a few areas in which innovations occurring or where emergent technologies are plugging into mobile, to give us some sort of context around where we're going as a set of consumers, where financial services is going as an industry, and see if you agree. So we've got 5 of them. I'm going to introduce them and then go through an example. And like I say, if you have any questions, please pop them into the chat at the bottom of your screen. So the first one is the integration of mobile solutions. Now, as the French say about fashion, less is more, hence the reason that you'll see so many people in Paris in just all black outfits. The amount of times that you search for a brand within the App Store or Google Play Store and you're presented with 2, 3, 7, 12 different options that relate to that brand is pretty astounding. And I think that as we head into 2021 and beyond, real estate on smartphones is going to become, people are going to become pretty precious about it, and they're going to want to have like a unified point of contact with individual businesses. Now, I just did a little kind of quick search, and so happy to be challenged on some of these, but examples are like Barclays, I think, have somewhere in the region of about 10 to 12 apps, and Aviva have 7. So there's like a whole sort of suite of mobile applications. And now, whilst I understand that these might be related to individual business units in large organizations, those individual business units might be run on their own P&Ls, so might have their independent R&D budgets or innovation budgets, and arguably definitely have different customer bases. I suppose for me as an individual, my relationship is with a brand, and with a financial services brand. And so my expectation as someone on is right on the cusp between millennial and Gen X is that there should be one point of contact. So I'm going to take an example that I know a little bit about because I used to work for Tesco Bank, but the intricacies of this in terms of Tesco Group versus Tesco Bank and the ownership and processing versus controller of data within the kind of GDPR structure obviously might mean that what I'm saying isn't actually doable, but my thinking here is to sort of illustrate what a consumer might want. And so at one end you have Tesco Bank's app, which is finance, through to Pay Plus, which is payments in store and in forecourt, and latterly you have Clubcard, which is related to rewards. Now, the unique selling point of Tesco Bank's products are Clubcard points. So not only do they have pretty good price and pretty good product, but they have this multiplier for Clubcard points. You come through to Pay Plus, it's a payments functionality. Again, the USP is Clubcard points, and latterly you have an app that is specifically for accruing, viewing, and spending your Clubcard points. Now, my point is that as a consumer, you'd be quite within your rights to feel like 3 is potentially too many apps, and actually it'd be better if you just had one app that did all of that functionality, especially considering that the finance, I suppose, is the gives you the flexibility to spend, payments is the conduit, and the rewards is the thing that you get back for interacting in shop and in forecourt. And so it's an example where I suppose going forward in the mobile space, people might look to streamline their mobile applications and actually make individual apps feature sets of a central app rather than having a distributed portfolio of mobile applications. The second one is a continuation of mobile as intermediary. So this comes from a lot of technologists, a lot of industry commentators were discussing that in a kind of post-pandemic world, we might not want to interact with things like touchscreens at Tesco or, you know, kiosks at the train station. And the kind of dominant kind of theme was that this might lead us towards the growth of voice, gesture recognition, and other touchless technologies as we move past kind of 2020 and into our sort of post-pandemic normality. But I think for us, we believe that that most of the use cases can be answered by the devices in our pockets. So especially with like near field communication, which obviously underpins things like Google Pay and Apple Pay, which is essentially just RFIDs, which have been used in shopping and agriculture for a really long period of time. We could see mobile devices being used as access cards for offices or, I don't know, like public access transactionals for, say, I don't know, like elderly access to bus passes, leisure cards and the like. But then similarly, I've seen examples where near field communications been used for hire car ignitions. So rather than, you know, being handed a an individual key. When you hire a car, you might actually just have a communicative device on your mobile. So there's an idea of mobile as intermediary. And whilst I got the most basic transparent PNG of an ATM ever, so apologies, hands up for that. My example is that if we, come out the back of COVID-19 in the post-pandemic world where we actually don't want to interact with communal devices, I just thought this would be a useful example in that you could walk up to an ATM and your device could communicate with the ATM instead of inserting a card into the machine, which obviously has in the past meant that, card readers which have been overlaid on the front of the machines have, had fraudulent activity on them. Like, you're a step away from that. You could choose your card on your device. It would communicate with the ATM. You would then put in your PIN number on your device, and then you would check your balance, ask for how much cash you wanted, and only pick up the clean, fresh banknotes as and when you finished your transaction. So it's the idea of mobile being something that you personally have that can communicate with infrastructure, is the idea of this growth in mobile as an intermediary. So that was example 2. Example 3 is the growth of inferred payments. Now, again, we're speaking about the mobile device as a role to play as a communicator. So at one point in time, hailing a cab was, you went to the ATM, you took out your money, you waited until you saw a cab, you flagged it down, you got in, you watched the ticker, you asked them how much it was, they said 22, you gave them 25, you got £3 change. Obviously Uber flipped that on its head, and now you have a mobile application, they have a mobile application, you have an agreement, you step in, you step out, the transaction goes through. The idea that is an inferred payment, that almost the actual transaction has been made invisible. It can be seen in plenty of other places too, like Amazon Go. So the idea that you can place things into your basket, the basket can be reading either a code or weighing, can understand what's in your basket, and actually at the point where you leave the store, that is an inference that you are agreeing to pay. And there's a few other examples. I think Starbucks in the US has like a rewards app where, as you're traveling towards a store location, you can place an order and pay via the app. And then when you get to the store, you can just pick up at the end of the service line. So again, it's all about less friction, more choice for the consumer, less physical interaction. So I've gone back to Tesco for an example of inferred payments. So during kind of April, earlier on in the year, when I went to my local Tesco, there was like a 12-strong queue outside the front door. You got in, you did your shopping. There then was like a big L-shaped 20-person queue waiting to be directed to individual tills in store. And my idea was that if you have a payments app like Pay Plus that was, changed or developed and scaled to allow you to scan your shopping as it was going into your cart, and then there was the technology and infrastructure in place for you to pay for that as you cross the threshold, you could do what most of these supermarkets are asking you to do at the moment, which is pack your shopping at your car, knowing that you have managed to, complete your shopping, complete payment without, I suppose, any of the inconvenience as we see it for the consumer, and any of the implications for the service provider related to managing that process through the till point. And I suppose if you take, any UK supermarket who has spent probably a huge amount of money in terms of building up self-service infrastructure, I can imagine that there's quite a lot of worry as to what will happen to that if people actually don't feel as comfortable relating to, I suppose, communal devices going forward. So that's an example of the growth of mobile inferred payments. Next one is a diversification of mobile functionality. So this could pertain to, I suppose, all financial services operations that have a mobile app. Within a mobile, you have a gyroscope, an accelerometer, a magnetometer, sorry, pardon me, a GPS, a camera, a microphone, and a range of other little devices. And obviously they can all be leveraged to do different things. In most instances with mobile financial services applications, very few of them tend to be leveraged. I suppose if you think about where they could potentially be leveraged, there's some really creepy ones like, life insurance application that could measure the movement of individuals or tap into the other applications like Strava to find out how much exercise is being done or how healthy a lifestyle is being lived, therefore reducing the cost to cover those people. But I suppose there's probably a range of more simple and arguably more interesting ways to leverage the sensor-rich internet-connected devices that sit in our pockets or bags. So yeah, my example here, illustrated by these three icons, is that to not collect any personally identifiable information and not make any, I suppose, grand statements which illustrate that you have tracked the user through the individual sensors within their device. My idea was that if you knew that someone was using your banking application when they were moving at pace, then you would have a broad understanding that they predominantly banked via the mobile application whilst they were commuting to work, which could trigger a push notification, which could reinforce a security message that just explained and supported I suppose best use case for mobile applications, especially when dealing with personal and private information. So that was just one small example, but I suppose that within these devices, there's a whole range of opportunities to allow the applications to tap into the sensors for some really interesting use cases. So it's another place that I think will grow as we move past 2020 and into 2021. And lastly, number 5 is the growth of the mobile-powered extended reality. And now, as I've said in this first paragraph here, I don't think like this jolly chap on the right-hand side, we're going to be youthful faced staring into cardboard boxes to have mobile VR banking experiences. But I think that we're going to start to see a lot of financial services organization leverage extended reality for interesting purposes for interacting with the consumer. Now, there's a couple of interesting examples that we've seen recently in banking. I think it was in Germany. There was so if you laid out your debit card and opened up the app, it essentially like popped up with like a little bar chart and percentages of what you'd spent on recently, then flipped up your balance and your overdraft, which is like an interesting use case, but I suppose not that adoptable in the respect that you wouldn't be able to do that when you were, on your commute into work. And arguably, if you were sitting in your house and you wanted to check your bank balance, you would just open up the app rather than going and searching for your wallet or purse and popping out a card on the table. Still interesting nonetheless. And in lending, there was an example in Germany, which I thought was quite interesting, where if you went to the forecourt of a car dealership, used cars, you could hold up the application. It would essentially like visually recognize make, model, and I think year, query it against the database, and then overlay an expected average price. And I suppose that the idea was that it's a brand touch point that might allow that financial services organization to further down the line offer a car loan or offer some kind of finance to deliver their new second-hand vehicle. And so I'll just speak a little bit about an augmented reality example of ours at Waracle. And so this is a practical AR deployment that we delivered in the financial services industry for Clydesdale Bank, which is now Virgin Money. So it's called the B currency app. And, you know, it solves for a real world problem of you're on holiday, you're looking at a menu, or you're looking at a piece of clothing, and you're maybe not that au fait with what the currency conversion is. And so the app used optical character recognition and near real-time currency API alongside geocoding to convert it visually in real time. And it even works with cryptocurrencies. You can do the conversion into BTC if you so please. But I suppose the idea of these kind of augmented reality experiences is that you're the brand that's facilitating the solution of a real world problem, which might not necessarily give you a direct line of acquisition, but what it will do is it'll build brand memory structures, and it will see you as diversifying from your sort of core banking service functionality into something that's more experience led. And I suppose that mobile in general, when you have an established mobile infrastructure, that's where differentiation comes, and where competitive advantage comes from, is when you move away from just, I suppose, the simple apps that just give you balances or just allow you to do basic service orientated items, and actually something that moves into much more of the experience space. So those are kind of 5 examples of where we can see mobile heading as we head into 2021 and beyond. And so my answer to why mobile in 2020 is because the culture demands it. And like I said, you know, we can take a cohort of kind of millennials and early late Gen Xers, pardon me, and we can know how people will interact with these devices, and we can use that to inform how we speak to the older generation to increase adoption and to increase their level of comfort with the flexibility and the built-in security of these solutions. And you know, we've got a generation of younger people who are going to expect this of every organization that they interact with. So yeah, that's my presentation. I really hope you enjoyed it, and I know Sharon is going to sort of mediate questions, so I'll look forward to answering a few of them.
Brilliant. Thanks, Blair. I really hope that that wasn't a segue of the older generation to hand back over to me, but
not at all. Not at all. You're same age as I.
So, you know, I know we've covered quite broad topics here. In reality, what we've seen with a number of our clients and throughout the industry is even where they haven't perhaps been any of the first to market with mobile offerings, a couple of them have said to us that this has moved their plans and expedited their plans probably at least 3 to 5 years faster than what they would have planned. And this is in markets across the board. So retail banking is obviously quite well covered with regards to this, although it has the layering of channels that I talked about and the issue of that. But there's a lot of other industries within financial, or other segments within financial services, that mobile adoption has been slower. And this, our situation that we find ourselves in, it has just kind of expedited it. And what we've seen go out throughout COVID, and trust me, our desire, or saying that mobile is an imperative, was true before COVID, but even more so now, because we've clearly seen organizations lose touch with their clients, being unable to service the clients, lose any effective way of communicating with them. So particularly some segments as well, where they've been quite disadvantaged because they've not been online or mobile adopters. So we've seen some pretty significant changes in terms of how a lot of organizations are going to approach this. It's layered on issues with regards to branches are closed, call centers are overwhelmed, dealing with, I don't know, whether it's mortgage holidays or a backlog that they need to deal with. The response, certainly in the early, I'd call it the lockdown shock of the first 2 to 3, 4 weeks that we all went into lockdown, responses were understandable, but incredibly slow. And as people got to grips with working remotely, and one of the interesting things for me, if you know my background at all, I worked at NCR for a long time with self-service and ATMs, and cash was not preferred and is still not preferred. And so in terms of what's changed there, there's been a pretty dramatic change in terms of how people approach it. I, for one, no longer walk about with a purse, you know, old school, but no purse, just a phone and a card just to make sure I'm not stuck. But that's quite a dramatic change, and I cannot see me going back to any other way of doing that. The thought of touching, you know, hand sanitizer is our life, and the thoughts of touching ticket terminals or ATMs or even branches to a degree is not ideal, notwithstanding that that's still required for a segment of the population. So we genuinely do think that in terms of the most secure device, the device that's in your hand, I say clean, it's as clean as you are, but at least it's only you that's touched it. So, you know, there's a lot of reasons why we feel that this is kind of just growing around it. So there's a few questions that I'm just going to pop into and throw them over to, I guess, between Blair and I will cover them. So Blair, I'm going to start with this one. Do you think that banks can compete with tech companies, so fintechs, I guess that means, in terms of delivering a tailored customer service, and how would that play on mobile?
Yeah, it's an interesting one. I suppose that my feeling has always been that, you know, that in whatever capacity, whether it was just in the payment space or, you know, whether it was in the crypto space or whether it came through to actual sort of traditional financial services products like insurance and lending, that the big tech companies would come in and play some part. I suppose what's reasonably telling is how light touch their sort of forays into it have been. I think the likes of Amazon, you know, I think they're constantly testing new business models to see what works, and probably have a range of different strategies that are being run in tandem to see if people bite and people start to adopt. I think, you know, on the point that I made earlier about motivations and behaviours and biases, I think that people still have, and especially I suppose my generation, I was born 82, so anyone born 80 and before, I would say, probably feel a little bit like the established players are more secure, slightly better regulated, slightly safer pair of hands. Whereas I suppose there is a huge, you know, sort of shift in the younger generation where I presume that they could be convinced to bank with bigger tech players rather than banking with traditional financial services organizations. But again, I think it's a behavioral shift that we've yet to see happen. But it's interesting to hypothesize about. I don't know if you have an opinion, Sharon.
Yeah, no, I think that's an interesting point. I think, you know, you'll have covered this before in many other conferences you'll have been at. I probably have a stronger relationship with Amazon than I do with my bank, or certainly with my insurance company. And that's not the least because I now feel like I have a personal Amazon driver turning up to my house most days. But, you know, that's a significant change from, obviously I've been around for a while, but in terms of my normal or previous financial services relationship. My pension is now available to me on my phone, which is the first time in 20 odd years that that's been the case. And I would say that I probably engage with it 4,000% more than I used to. And that's a dramatic change for me, and I'm sure it is, and I know it is for the organizations that offer that kind of thing, of rather than waiting for the one letter once a year that I try and decipher in the post, that I can actually look it up and work it out myself. So I think these kind of changes, there's a big change in terms of the loyalty and the brand awareness and the brand recognition, and you know, hopefully, you know, hopefully the financial services organisations, many of them are doing it already, but are able to kind of keep up and keep going with this. Blair, there's a couple of other questions here. Do you think consumers will be receptive to brands making use of sensor-rich functionality that our mobiles offer, e.g. insurance, life insurance and Strava example? Or will privacy concerns stall this innovation?
Yeah, I think privacy concerns definitely will stall some of the innovation. I think there's, I mean, Sharon alluded to it at the beginning, that there's a lot of sort of alignment between the digital health space and financial services. And I think that in a lot of instances, digital health probably has more of an understanding of how to leverage sensors for unique kind of customer orientated outcomes. I think probably, you know, even given by the fact that I could only come up with a couple of examples, I think that there's probably a lot of work to be done in that space to look at what's the best for customer outcomes. None of least because, you know, there's going to be a lot of scrutiny when businesses do start looking to do that with, you know, the regulators. So I can definitely see. I mean, like, you know, America's a market that's primed for, you know, kind of leveraging information for, you know, health insurance or, you know, broader kind of impactful stuff that's related to how active people are. I think in the UK, probably slightly less so. But I think there's lots of...
Blair, I'm going to disagree with you on this
one. Okay, 100%, do it.
Yeah, just to be argumentative. I think it's partly true. Would I want to give my details? Probably not. Would my nieces and nephews? Wouldn't think twice about it. If it meant that they got cheaper insurance premiums or better offer or tied around with connections to their gym or their schedules or their fitness or their whatever, I don't think they'd think twice about it. And so I think there's, I'm not going to broadly say it's a generational thing, but I do think there's an element of the segments will accept differing levels of what's acceptable and what's not, and what's the trade-off or the benefit of what I get. So I actually think that that has quite a lot of legs and could move quite quickly. If the offers surrounding it weren't just, I think you need to go beyond that it's just a cheaper premium, although that's probably very attractive, but then perhaps to one of your points earlier of trying to pull a lot more things together, that it's the services come together even via multiple organizations. So your gym, your insurance company, your whatever it happens to be within that. So I'm just going to jump on so we don't miss out any of these questions.
Yeah, go for it.
There is, here's an interesting question. Insurance seems to be dragging its heels in the mobile space. Do you see this changing, and what could be the trigger to this, to seeing this happen?
I think it will change. I think it definitely will change. I mean, my experience in the insurance space is that, especially in the insurance that you have to have, so if you look at like motor insurance or, well, if we look at motor insurance in particular, I don't think anyone really feels much about who their motor insurance is with. Whereas if you take it across to pet insurance, people that have pets, they're another family member. And so there's probably quite a lot of people that genuinely care about who their pet insurance is with because they care about their pet. And so I think that there's different areas of insurance which arguably have, I suppose, more of a brand play and more of a direct relationship with an organisation that's providing your cover. But I think the majority of them will head in the direction of mobile, just because it is so, like, in the sort of commoditized world of how people purchase insurance, they go to a price comparison website and they broadly choose the cheapest insurance. Now, the job for the insurers is to get them to renew after 1 year or after their initial term. And that means creating some kind of brand experience and some kind of trigger to reacquire them, because you don't want them going back out to the price comparison site every year and having to repay for them through Money Supermarket or the like. So I think that like the brand experience bit, to a certain extent, will live on mobile for insurers, and I think they're going to have to move in that direction, and pretty quickly, arguably.
Yeah, there are quite a few movers and shakers in the space in terms of moving, that have moved with insurance. I do think where the likes of a price comparison website is involved, then it does dilute the brand without any doubt. I'll go back to my pension example before. I've now got my pension app on my phone. If my pension company also offered me insurance, I'm quite sure I would have a look at that before I went off to a comparison website. So I think it partly comes back to trying to tie everything together in a seamless relationship with that as well. Here's probably just got, we've got a little bit of time. So here's another question of having twice been on the end of having my online bank account hacked, losing money and getting it back eventually, but time spent doing so. Trust remains the biggest challenge, and I can imagine getting the older generations to fully adopt will take time. Do you want to have a go at that first, and then I will?
Yeah, definitely. So I think, yeah, it's a massive concern. I suppose it's interesting if you look at someone like Monzo, you look at how they've built their organization, and you know, the kind of machine learning infrastructure that they have in place, and I suppose the processes that they have in place to identify fraudulent activity. And there's been a number, I think, of high-profile instances where, like, a large cross-section of of Monzo cardholders have had their cards replaced pretty much overnight based on the flags that have appeared in these systems. And so it's always going to be a balancing act. I mean, there's always going to be smart people working for people with nefarious intentions, which is a difficult one because it means that you've constantly got to try and stay ahead of some of the smartest criminals out there. But I suppose that, you know, as the consumer, the bit that you want to know is, like, is it dealt with swiftly? Do I get my money back quickly? Is my relationship with the organization hurt from having had that experience? And so I think the bit that banks and financial institutions need to focus on is that piece, is like, how quickly can you isolate and fix the problem? Because the lag where people are worried, they call contact centers don't know anything. They're given kind of like wait times that are 3 to 5 days or the like, especially in situations where people maybe don't have backup savings or current accounts that sit within other banks. They can be really, really difficult situations. So I think that there's always going to be that security concern, but I think it's about addressing that from both an infrastructure point of view and from a brand point of view, by ensuring your communications are spot on.
I think there's a design piece in here as well in terms of the solution design. When I worked with ATMs and self-service, we most definitely had simplistic models versus more complex transactions. And there was lots of conversation, and different organizations around the world did tailor them based on what an individual needed. You don't see that quite so much in the UK, but I think mobile's a really much more effective device for this kind of thing to happen. And so to Blair's grandmother or to my father-in-law, they have phones, but wouldn't use them necessarily for transactional information. And so I do think that potentially, you know, this is all investment and cost, but there is a potential in here that says even an adoption of getting a non-transactional balance only function would be useful, certainly to my father-in-law, who feels it's important to probably walk down to the bank every day to get his balance, just to make sure the scammers that he sees on the BBC and the like haven't taken his money. So I do think there's options. You know, we never talk about the really simplistic options of apps because we're, you know, busy thinking about all of the cool things that they can do, but actually there's some really basic non-transactional things that actually add a great deal of value and could help with, you know, I think it's unlikely that you'd get full adoption with the older generation. anytime soon. However, there are big steps that could make their life much better and also help them work with the organizations that they're dealing with. So one more, we'll go for one more here of how do you think financial organizations are going to ensure the best genuine advice is out there to match the products? With fake news prevalent at the moment, how do they overcome this challenge? So let's think about that, Blair, in the context of that this exists regardless. This will exist on whether they're looking up websites or whether they're seeing a print advert versus seeing it on mobile. So I think in the context of that, if you want to have a think about how they would get correct information to a client or a prospect.
Yeah, it's so difficult. I mean, especially in the retail banking space, someone might, come to a bank for a loan, and they might want a reasonably sort of large amount of money. They might want a small amount of money. We'll say, for example, they want £8,000. There is some devices and products within that bank which are a better option. So like it might be better to get a purchase credit card with a really long term where you can just get the credit card, get a credit limit, buy the item, and then pay it back over the 0% term on that credit card. That might be better than getting a loan. But a bank's never going to give that advice. So even banks and financial institutions can't necessarily give the best customer-led advice. The customer kind of has to find it by themselves, which is difficult to the point that was made about the kind of space of kind of fake news and the like, is because it's very difficult to do your sort of like your epistemological kind of like sense making of like, here's all of the bits of information that I have, which of them are factually true versus which are, debatable, which are factually untrue. So, I mean, it's an ever more challenging problem. I think that the biggest thing that I've seen financial services organizations do over the last kind of 5 to 10 years is they've spent a lot of time building out these kind of content hubs or building out like customer communities to kind of facilitate those kind of conversations, to have sort of owned infrastructure that challenges preconceptions about financial products, life stages, and I suppose encourages that kind of peer-to-peer communication. I don't know if that's a great answer to the question, but I think it's a difficult one because I don't think there's always a clear line on what can be seen as guidance versus what tips over into advice, which obviously the regulator kind of frowns on. I don't know what your thoughts are, Sharon.
Yeah, I guess there's a difference as well between a general broadcast versus what you could receive directly from an app. And so the communication could be a lot more direct and I guess accurate, hopefully accurate if it's coming from your provider. And as I'm sure you all know in terms of how you can communicate using mobile within an app, then it's a pretty easy system to put in place in order to do that, assuming that the client's yours in the first place, obviously, and that they've got an app. I think much of this is, I think without a doubt, it's been expedited. I think we still stand by mobile's the way to go forward. There's lots of technical parts that we could speak around this, which we were possibly purposely avoiding today in terms of just pushing forward that things have most definitely changed. Not necessarily for the those that live and breathe by their mobile every day and wake up with it and stare at it anyway. They will adopt it anyway, and they will expect cutting edge technology and new things like VR and AI and all of those cool things to come in and start to play. They will, generalizing, but question less about how they use or how they trade perhaps their data is a better way of looking at it, trade off their data for a better price. And so I think there's one category in terms of those kind of adopters, and then the rest in terms of how the rest of us change and adapt and move on, and whether those offerings are going to be key to us making decisions going forward as to who we choose to bank with or insure with or have our pensions with or so on. I'm going to leave it at that. I know we're right on 3 o'clock. I hope that you found it useful. We will most definitely send out more information of this. If you want a recording, then get back in touch with Heather, and she'll definitely hook you up on that. But thank you all again for your time, and hopefully catch you again soon. Thank you.
Thanks so much.